Hello, this is Amillex AI Analysis. Let's start with the US dollar, which weakened noticeably after the Federal Reserve's decision yesterday. This move marked a clear shift in momentum, especially after the dollar had shown remarkable resilience over the past few weeks. The selling pressure wasn't random. It was driven largely by what we call mechanical post-decision flows. Whenever the Fed cuts rates, yields tend to adjust lower almost immediately, and that forces repositioning across global markets. As yields drop, the dollar usually follows, and that's exactly what unfolded last night. Now keep in mind, the dollar had been on a strong 2-month rally, pushing to fresh cycle highs. So this latest pullback shouldn't surprise anyone. After such a significant run-up, outflows are a normal part of rebalancing. So what's interesting is that this weakness didn't just benefit major currencies. Exotic and emerging market currencies saw some of the biggest boosts. These currencies are extremely sensitive to shifts in US rate expectations, so the reaction was amplified. Heading into the Fed meeting, the dollar was still holding near its highs, even though the market had already priced in a dovish adjustment. A big reason for that was elevated Treasury yields, especially after New York Fed President John Williams delivered some hawkish remarks earlier in the week. His comments helped reinforce the higher-for-longer narrative, keeping the USD strongly bid up. But once the Fed confirmed its policy pivot, the reaction became decisive. Yields eased sharply, removing a major pillar of USD strength. Funds that had chased the late-cycle dollar rally began unwinding positions, and risk sentiment improved, reducing the dollar's appeal as a safe haven asset. So overall, what we're seeing for now is more of a natural correction, not a full structural reversal. Whether this becomes the start of a broader dollar downtrend will depend heavily on upcoming inflation data and future Fed communications. Now, let's link that back to gold, because the chart is shaping up beautifully. Gold has been steadily climbing, forming a clean sequence of higher lows. This rising trend line, active since early November, has been a major source of support. Every dip into this zone has been aggressively bought, showing strong demand under the market. Right now, price is testing a key horizontal resistance between 4,255 and 4,280, the same region where sellers stepped in heavily back in late October. What makes this especially important is the pattern it forms, a classic ascending triangle. We have a flat ceiling, higher lows pushing upward, and momentum gradually compressing. If gold manages to secure a daily close above 4,280, that breakout opens the door toward the next upside levels around 4,320 to 4,350, with potential extension if volume kicks in. On the flip side, if price gets rejected, we could see a pullback into 4,230, or even a retest of the rising trend line, an area where many buyers will likely be waiting. But the bigger picture remains bullish as long as gold holds above that ascending support. And with the US dollar cooling off after the Fed's move, the macro backdrop is now more supportive for gold in the near term. Just remember, it's December, liquidity is thinner, and volatility can spike without warning. Manage your risk accordingly. This market update is brought to you by Amillex AI. Stay disciplined, stay informed, and I'll see you in the next breakdown.